Hello, welcome back to another trading video. Like you said in the intro, this is not financial advice. I am not a financial advisor. Everything is done. Do your own risk, do your own due diligence. Go into the market with correct position sizing, just as the disclaimer has shown before. So today in this video, I will be breaking down two of the trades I took this week on the NASDAQ index that profited me 16 RR. It was, I think, over 100 points in general. This was, of course, on the futures market. As you can see here, NQ trade breakdowns slash recaps, 16 RR trade setups using MMXM and anticipatory breaker strategy. I don't own the anticipatory breaker strategy. It is from one of the people that I've been following. I will link his YouTube down below. And he teaches and go into depth about the anticipatory breaker strategy. You will not be getting an in-depth teaching over here. But without further ado, let's get into the video. Make sure to like and subscribe. So the first trade I'll be going over was the market maker sell model on NQ. On NQ, we had a market maker sell model, 15-minute to the 1-minute, internal range liquidity to the external range liquidity. If you don't know, this is how the markets book. The markets book from internal range to external range liquidity. It's based off of liquidity. That's how the algorithm and the interbank price delivery, that's how they book it. It also goes from premium to discount, but I won't be teaching you that here. This trade took place during the Asia kill zone. The bias was bearish as we were tapping into an hourly and 15-minute sell side imbalance, buy side inefficiency, which is just a fair value gap. We had built up sell stops and had a lot of accumulated orders from news and AM session. During FOMC, we had a huge bull run, resulting in the market being overbought. Orders were not offered anywhere in that run, so we had to come back into a discount to offer orders. With this bias in mind, as we respected the 15-minute by CB, the fair value gap, with the bodies of the candles, I went to the 1-minute time frame to frame an entry. As you can see here on the right, I have a market maker model. This is just for seller buy model marked out. I'm just going to do a quick overview. This is a market maker buy model where you have original consolidation on the time frame that you're entering in. Then you have a redistribution, a smart money reversal off of a key high time frame PD array or level. So whether it's swept liquidity or it reacted off of one of the PD arrays. Then you have your low risk buy, you have your reaccumulation, and then you have your terminus. And it's the same thing, just flip it for the sell model. So as you can see here on NQ, we have a 15-minute CB right here for value gap, which prices continue to respect. This is the FOMC news on where it was way overbought. You could tell by the bodies here that the price, as you can see right here, I said note the bodies, price is respecting this fair value gap, and that's exactly what we want to see if we want bearish order flow. We had accumulation right here. We had a lot of low resistance liquidity and accumulated sell orders right here. And you can see overbought sell side. Sell side was not offered through here at all, through the news and through the macro, which is why I was confident in price doing a little bit of retracing. So as you can see here, after we reversed, I said note the levels in the volume imbalance protection. We reversed off that level and created a low risk buy. We had a volume imbalance right here, but what I was mainly focused on was the sell side imbalance, buy side inefficiency that got created in here. I'm going to say fair value gap just for simpler terms, the fair value gap that created in here. So I marked out its quarters. Usually you only have to just mark out the whole thing and then the halfway point, but I wanted to mark out the quarters just to see how far the bodies were going to go and how far the wicks were going to go. Like we said, the bodies tell the narrative and the wicks do the damage. So as you can see, the bodies were all closing below the 50%. They were respecting about the 25 quarter level of that fair value gap, and it kept testing it. Now this is an Asia session, so in order for me to be confident, I would like it to at least see a few heavy rejections. So once I saw it reject and respect these levels, I said, okay, this is my low risk buy. we had the original consolidation lower. I'll enter here for a trade. And I noted that these are pending orders, pending sell stops that we want to see price inverse with velocity. We want to see price inverse this fair value gap with velocity and come to sweep these lows. If we disrespected this bullish PD array, it will give extra confirmation for bearish order flow, and you could take another entry off of there. So as you can see here, I was noting to pay attention to the bodies of the candles as they were failing to displace higher than the halfway point. As you can see here, we did have a wick that came all the way through, and it looks like it just barely touched this volume imbalance. But look at the bodies of the candle. It's clearly indicating bearish order flow. This was just a sweep on this high. So as we were going down, I wanted to see price inverse this still with velocity. If price continued to hold this bullish PD array, then we would be on the wrong side of the market and we would have got marked off as wrong. So if it inverses, I set my limit to take my first partial here, as this would be the first low of our dealing range as price entered this premium. This could be a good enough just overall in the move, so we were able to cover our costs. And as you can see, I just had that noted again. I want to see price disrespect this bullish PD array, and I started to mark out further liquidity points on where I could take some partials. Price was still respecting it, but as long as it was respecting this fair value gap and I allowed it to trade a little bit into this volume balance, I was not worried at all. This is also an order block, so you can see we have multiple PD arrays protecting our position. So I put my stop loss just a little bit above the mean threshold of that order block. And as you can see, price inversed it right here, and this could have been another entry off of the model that I used, but you could have pyramided your entry right here, or there's further pyramid opportunities. But as you can see, as soon as we inversed that, we took it actually out with this low, but we created equal lows, which made me even more confident on why this was going to go to this draw. So as soon as it went towards it, it hit my limit, moved my stop to break even, my risks were free, and my costs were covered. Scratch itched just in case I just wanted to trade because I was barely able to get any during school. As you can see here, this was the next liquidity point. I didn't want to take off too much of my position because we were still very high up into the move. We were still in a premium. So I wanted to start scaling my position down at liquidity points as we went along. And from there, price just continued to drop. You had another entry right here. This is a fair value gap and this is a volume imbalance. It also tapped into this order block right here. So you had multiple opportunities to pyramid your entry right here. You could have pyramided off of the inverse. There was just a lot of pyramid entries, as you can see. Price also inversed this buy side imbalance, sell side inefficiency that was continuing to hold price. So once we knew that this was inverse near the equilibrium point of the whole move, we knew it was going to go down. So some nice liquidity, don't mind if I do. And we had equal lows resting over here that was near a volume imbalance. So as you can see, I scale profits here and here. Then I want to scale some because if you remember what ICT said, you want to always take off most of your position with some liquidity near the equilibrium point, because once it reaches this 2 to 2.5 standard deviation, price usually likes to retrace. It doesn't always retrace, and it doesn't mean it's always not going to go through, but price usually likes to retrace. So I had about 5 contracts left, and I was waiting for it to ride down to this low where we still had a lot more resting liquidity. And price did exactly that. Usually you don't get this big of a move in Asia session at all, but I was able to catch the bulk of this move, which resulted in, I believe, a 1 to 8 RR. As you can see here, price completely, this was the accumulation. And then you had your reaccumulation, distribution, smart money reversal. This is your MMSM. It's not always going to look pretty in textbook, but as you can see, it was a beautiful sell-off from there. Price just didn't offer anything really in the second leg of it, but once it inversed this, like right here, once it inversed the PD array, that's where you could have entered off the left side. I'm not going to go much into market maker models, but as you can see, this was the completed one right here. Now we have another one, NQ as well. This was the Anticipatory Breaker strategy, ABS. This was our NQ ABS buy model. On this day, we had non-farm payroll. If you don't know, that's a pretty volatile. It's on the hierarchy for, I think, top 3 of the most volatile news. So we were getting a lot of volatility injected into the market. This was our economic calendar for that day. So we took our trade post 10 a.m. You always want to take your trades after all red folder news is released, just because it gives you the highest probability without any of your positions getting reversed due to the injection of volatility. And this is the anticipatory breaker strategy. I'm not going to explain it. If you want to pause the video and read about it, you can right here. But this trade was taken during the New York AM session post 10 a.m. and it was extremely volatile news using Adanomics ABS model. The bias was bullish as we were sandwiched in between two inefficiencies. We had swept sell side liquidity and price was only respecting the equilibrium point, the consequent encroachment of the 4-hour buy side imbalance, sell side inefficiency. But on the 1 hour, we were closing above its equilibrium point, which indicated higher prices. We had equal lows above and had our C spot form sweeping liquidity into a 15-minute sell side imbalance, buy side inefficiency, and discount around the classic 4-hour open low high close 10 a.m. reversal, which also was news. Adding extra confluences to the big expansion. Now I know that probably sounded like a bunch of gibberish, but I'm going to explain it all in the following slides. So as you can see here, this was when we were sandwiched in between two inefficiencies. But if you look here, look at this heavy wick. We have our dealing range marked out. Note the heavy dump, yet close above the 4-hour buy side imbalance, sell side inefficiency. We tapped into discount of our dealing range, which means once we tap into internal range liquidity, what can we aim for? External range liquidity right here and right here. So really, this doesn't tell us much, so we drop down into the 1 hour and note the bodies. Look at how the bodies to the tick respect this 4-hour fair value gap. It's completely respecting it to its equilibrium point, tapping in and digging into it a little bit, but its bodies is showing a great indication that it wants to go higher. We had resting equal highs right here, which serve as great liquidity pools as well. And then we just had to wait for our setup to form. This wasn't a valid setup. You never want to trade the 10 a.m. reversal because it's just not going to do you any well. You don't want to really trade this chop. You could have traded this chop like maybe right here, but you weren't going to get that much good of an entry. Your stop would have been to break even right here, so you would have lost. But it's not clear. It didn't go into a discount really, and we still had a buy side balance and resting orders that we wanted to fill. So what happens? We get our A leg, our B leg, our C leg forming at the low of the 4-hour candle, as you can see here, along with the fact that it tapped into an inefficiency and it swept liquidity. I was very confident in this expansion. We set out our standard deviation, and our standard deviation matched up with some equal highs. We also got resting equal highs right here, which is what we always want to aim for. We inversed our fair value gap, and that's exactly where I entered. I was in class when I caught this, so I couldn't make clear annotations, but here's the 4-hour high we have, and I was confident it was going to go at least to these resting equal highs. So that's where I would take off the bulk of my position. So as you can see here, price expanded beautifully to this right here, and that's where I took off the bulk of my position. We had another equal high right here that lined up with our 2 to 2.5 standard deviation. So at first, this was about to be my full take profit, but because of the 4-hour high, I wanted to at least hold it a little bit. So I decided to take off the bulk of this position that I had remaining around these equal highs, because the 2 to 2.5 standard deviation is known for retracements. As you can see, I marked out our levels, took out these equal highs, first partial taken, cost covered, and I was confident in leaving it right here because this should have acted as a breakaway gap for price to expand higher. Price did in fact take that, as you can see, so I decided to take off the bulk of that position, leaving us with 6. I decided at the 4 standard deviation we could take 3 more and then hold the rest until the pending orders at this high that we had, the 4-hour high. The second partial was taken. I noted that this fair value gap could be used as a pyramid entry, and this was our last line of defense before we pushed to these highs. Let's see here. As you can see here, potential pyramid entry, pay attention to its bodies. And this was during a macro. So this is exactly when I thought it was going to come to sweep not only this high, but the 4-hour high. This was our last line of defense, but price ended up not sweeping that high and dumping down. And it respected the consequent encroachment of this fair value gap. Remember to always pay attention to the bodies. So what it do, it went and after that reacted beautifully. This could have been another pyramid entry, and this is where I trailed my stop because it shouldn't come back here. This already acted accumulation, manipulation, distribution, redistribution to go higher. 4 standard deviation. Our final partial taken was hit, and this was about a 1.8.5 RR, by the way, as you can see here. And then this macro dumped it to the high. As you can see here, it completely went high before dumping lower. Like I said, profits shown as I managed the trade. Don't mind the balance because I was just trolling during Asia session a few days before, just to like manage emotions and risk. But as you can see, this trade ended up playing out for a lot. And yeah, that's basically the end. As you can see here, as I was going through this trade, I was looking through the community, and there was actually 2 trade setups. I wasn't able to catch the 931, but I did catch this one, and this is just shows that it's really universal. Once you see it, it's just hard to ignore. So that's really all I gotta say. And yeah, if you enjoyed this video, if you found it informational, let me know down in the comments below. Let me know anything I could do better. Make sure to study this video, watch it over again until it clicks. Let me know if you have any questions, and thanks for watching.